Hello everyone, good day to all of us. To my students, as you watch this video, thank you for staying at home and staying safe. This is again another topic that we are going to discuss. This is entitled Inventory and Cost of Goods Sold. So in this topic, we will discuss the asset, which is next liquid after receivables. So it is um, still part of the current assets section of the balance sheet. Because inventory is, although it's not liquid as receivables, but it is more liquid than assets like property, plant, and equipments. Okay, so let's start by definition of inventory. So when we say inventory, this is the term for goods available for sale and raw materials used to produce goods available for sale. So when we say inventory, it is the items which it's in stock in order for you to sell it, for sale, or raw materials which is used to produce goods for sale. So for example, in a typical grocery business, their inventory would include the grocery items and as well as the, for example, packaging items. Those are also part of their inventory. In a typical bake shop, okay, inventory would include the finished goods, so the bread or the display in the area. It would also include the raw materials which is used for production of bread. In this case, like flour, milk, oil, and so on. In a real estate business, their inventory would include real estate, or the um, homes or houses which are built for sale. Although in our previous discussions, buildings are part of the property, plant, and equipment. But that is only applicable if your building is used for operations. But in real estate business, wherein the building is part of items for sale, that is actually included as part of their inventory. Okay, so the following figure shows the difference in the presentation of financial statements of a service type company and a merchandising company. Of course, highlighting inventory. So in our presentation, we can see here on the left side is a service type company, and on the right side is a merchandising type company. So as you can see, in the income statement of a service type company, the first line item there is service revenue, then deduct all expenses, then you arrive at the net income. While in merchandising type company, you have sales revenue, then you deduct cost of goods sold, and then you arrive at the gross profit. Then after that, you deduct the operating expenses, and then that time you will be able to arrive at your net income. So the difference here is the presence of cost of goods sold. Because every time you sell something, in a merchandising type of business, every time you sell something, that something has a cost to you. Like for example, you bought a ball pen worth 10 pesos and you sold it for 15 pesos. Okay, so your sales there is 15 and your cost is 10 pesos and your gross profit is 5 pesos. Okay, so it is to be noted that the income statement of a real estate company, revenue account, service revenue is account is used. While in a merchandising type company, which in this case Under Armour Incorporated uses sales revenue, and there is an account called cost of goods sold. Okay, in a balance sheet, of a service type company, and merchandising type company, okay, you can see here that the presence of inventory, in a merchandising type company, while in a service type there's no inventory. Although there are also instances wherein a service type company could have inventory, like for example, if the business is laundry shop, that is a service type, but they still maintain inventory, like for inventory of the soap, no, or the fabric conditioner, no, in case of a laundry shop. So they still have inventory, but generally speaking, no, that inventory is low level as compared to inventory in a merchandising type of business. Because in a merchandising type of business, they generate income or revenue based on selling goods. So therefore, there is considerable amount of inventory in their balance sheet. Okay, so let's have an example. Suppose an outlet store has in stock of 300 men's Under Armour fleece hoodies that cost $30 each. Okay, the store marks each hoodie up by $20 and sells 200 of the hoodies for $50 each. After the sale of the 200 hoodies, the store's balance sheet reports 100 hoodies that still the company holds in the inventory. Okay, so if you analyze, no, there is this 300 units of item, and you sold 200, meaning there is remaining 100 hoodies, no, in the balance sheet. The income statement reports both the revenue from and the cost of the 200 hoodies sold as shown below. Okay, so in this illustration, we can see that in the balance sheet of a merchandising type company, you will present there, no, in the inventory section, that is actually in the current assets section of the balance sheet, the remaining amount of inventory on hand. Okay, so that's the inventory that is still unsold as of the balance sheet date. And on the income statement, you will see here the sales revenue. Of course, the sales revenue is computed by multiplying the number of units sold, which in this case, it's 200 hoodies times the selling price, which is $50. So all in all, $10,000. And cost of goods sold is computed by multiplying the number of units sold, which in this case, 200 times $30, which is the cost of the hoodies. Okay, so which means that the gross profit here is 4,000. This is how you're going to present the inventory in your financial statements. Okay, the cost of inventory on hand, or the remaining inventory or unsold inventory, is an asset on your balance sheet, and the sold inventories are reported as expense on your income statement. Okay, note the difference between the sales price, also called the selling price of inventory, and the cost of inventory. Okay, so again, no, this is how we are going to compute inventory in our financial statements. So again, inventory is reported as asset, cost of goods sold is reported as expense, and sales revenue is reported as income. Okay, so normally inventory, or the number of units on inventory on hand, is determined by a physical count on goods at year end. Okay, so I presume most of you already known or experienced or even saw, no, businesses conducting a monthly or yearly inventory count. Okay, so that is essential in a business, because that is the only way that you can be sure that your items is still intact, no, there is no theft, no, in the store or whatsoever, or there are no damaged goods in your store. So when can we say that a company legally owns the inventory? Okay, so because the inclusion of inventory in the balance sheet depends on the legal ownership. Okay, there are times wherein you hold the inventory but you don't own it. Okay, so for this purpose, a retail business is required to exclude from its inventory all items that are held on consignment. Okay, so when we say consignment, so it's a system, no, of selling goods, or in the consignor, no, left its goods to the consignee, and then wait until the consignee sells the goods for a fee, and then pay back the consignor the amount agreed upon. Okay, so normally class, when consignment happens, there is no actually transfer of ownership of the goods. No, when the consignor delivers the goods to the consignee, there is no legal ownership or transfer of ownership to the goods. There is just transfer to the possession of the goods. No, but the owner is still the consignor, not the consignee. Meaning, if there are risks of spoilage, for example, in case of food items, or in case of damage, no, the expense or the damage will be borne by the consignor, who is the legal owner of the goods. Okay, consignment inventory is reported on the balance sheet of the owner, not the company holding the inventory. In addition, a company might have to include items that are in transit from its supplier or in transit to its customers, depending on the terms of shipment. Okay, so I'm sure you can recall, no, our lesson on our last video, discussing about FOB shipping point and FOB destination. Okay, just a brief review of what is FOB shipping point and FOB destination. When we say FOB shipping point, the transfer of goods is transferred to the to the buyer upon shipment. Okay, while if the agreement is FOB destination, the transfer of goods happens when the items arrive at the destination or on the buyer. Now let's have an example. If the seller is from Cebu City and the buyer is from Manolo Fortich, of course, no, you cannot just buy goods, no, without freight. No, there is always a freight because Cebu from Manolo is far, no, and you need shipping, no, in order for your items to arrive in Manolo Fortich. So if the agreement is FOB shipping point, the transfer of goods happens by the time that the goods is shipped by the seller. Meaning by the time that the goods left at Cebu City for shipping to the buyer, there is already transfer of ownership. Meaning, while the goods is still in transit, it is already the buyer is the owner of the goods. No? Because the transfer of ownership happens upon shipment. But if the agreement is FOB destination, okay, so the transfer of ownership happens when the items arrive at the destination. Okay, so meaning while the goods is still in transit, no, while the goods is still on the sea, no, the owner is still the supplier or the seller, no, because it did not yet arrive at the destination. Okay, so what's with that, no, in the determination of the ownership of inventory? Okay, there's no actually material effect on that, no, especially if the sale was consummated within the year, no. But the only difference that this FOB shipping point and FOB destination would bring us, no, in financial reporting is when the goods is still in transit on December 31 of the year, no, because we know that every December 31 of the year we have to prepare financial statements. And when we prepare financial statements, of course, we have to report how much is the inventory and how much is the sales, how much is the purchases. Okay, so we need to determine who is the owner of the inventory. Okay, so while the goods is still in transit on December 31, 2020, for example, the owner of the goods would depend upon the agreement. Okay, again, if the goods is still in transit on December 31, 2020, the owner of the goods, if in case of FOB shipping point, who is the owner of the goods? It is the buyer. Okay? Meaning the buyer should report that in their inventory and the seller should not report that in its inventory in their balance sheet. On the other hand, if their agreement is FOB destination and while the goods is still in transit on December 31, 2020, the owner of the goods is still the seller. It's not the buyer. Okay? Because the transfer of ownership will still happen upon arrival of the goods. And since the goods did not arrive yet on the place of the buyer, the goods is still owned by the seller. Therefore, on December 31, 2020, while the goods is still in transit, the one who should report the inventory in their balance sheet is the seller. Okay, it's not the buyer, no, because the seller is the owner of the goods. Okay, so there are two main types of inventory accounting system. We have periodic inventory system and perpetual inventory system. So let us discuss them one by one. First is periodic inventory systems. So this is a system whereby goods are counted by hand and then priced at certain intervals, okay, monthly, quarterly, or yearly. For example, a small local hardware store that has been in business for many years might not keep a running record of every board or nail it sells, no, because those are relatively small in value. Instead, the store might count and price its inventory periodically, no, at least once a year, to determine inventory quantities. The store would also keep a record of inventory purchased. It would then calculate cost of goods sold using the following formula. Okay, so under periodic inventory system, there is no record, no, of how much is the item left for nails, item left for board, item left for paint. No, there's no record, no, in case of periodic inventory system. So what happens in periodic inventory system is you just get the total, how much is your beginning inventory, you add all the purchases made within the period, and you deduct the ending inventory, no, and whatever is the remaining amount, that is your cost of goods sold. Okay, the formula is still correct, no, but the only disadvantage in this system is that you will not be able to know if your system, if your items were stolen, no, because that is present in any store, no, or the items were damaged, no. So you will not be able to report that, no. So if somebody stole your item or somebody stole from your store, and you will use periodic inventory system, most likely the stolen goods will be included in the cost of goods sold, no? But periodic inventory system is practicable to use if your items will have relatively small amount or small in value. Another inventory system is perpetual inventory system. This perpetual inventory system uses computer software and barcodes to keep a running record of inventory on hand, purchased, and sold. Okay, in old books, no, if you have your old books, perpetual inventory system uses stock cards. Okay, maybe you are familiar with stock cards, no, just like your library card, no, in the library, no. So it's like an index card, no, or any card, wherein you will be able to see there the beginning balance of that item, specific item, meaning one item should have one stock card. Okay, so items beginning plus purchases minus sales, and you'll get the ending balance. Okay, when a business purchases inventory, employees run items through a scanner which reads the barcodes on them and adds them to the inventory account as well as to accounts payable. So again, this is only present under perpetual inventory system. And since we are using a new book, no, the book assumes that we have computer, no, because as of now, computers are more efficient than using stock cards. No? Aside from you do not keep the physical card, no, you have less storage. Computer gives you accuracy, no, in the computation, and less hassle. So in the new perpetual inventory system, we are using computer. In the old perpetual inventory system, when computers are not yet that available, we are using stock cards. By keeping a running record of all items purchased as well as sold, in addition to beginning and ending inventories, a company always has a record of how much inventory should be on hand. Okay, so It's very specific, no? Because in perpetual inventory system, you will be able to know how many items should be left in nails, in board, in paint, color white, no? So you will be able to know the running balance of those items. And normally, what you're going to do now is to just check in the actual number of quantities. You just cross-check if the records in your computer is correct. Okay, if the items in your computer is equal to the actual items on hand, then you don't have any problem. No, everything has been accounted for. But if your items in your computer is not the same as your items at hand, then probably there's something wrong. Probably it's in your recording, or there are unrecorded sales or unrecorded purchases, or the items were lost in the process. It it might be stolen or it might be damaged. No? So perpetual inventory system is, for me, it's better, no, compared to periodic inventory system, no, because you can really monitor all items. But in accounting class, you have to always take into account not just the system or the accuracy of the system, but as well as its cost. Because there are times wherein the cost of running an accounting system is so high, you know, that your business cannot really pay, no? So let's say for example, you have a sari-sari store, small sari-sari store, no, and you really wanted to deploy perpetual inventory system. So you have a sari-sari store, and yet you have a high-tech computerized system, no, in order for you to monitor your candy, your sugar, your noodles, and whatsoever, no. So per item, it's encoded in your computer. Well, that's good, no, but you might be paying so much, no, because your store has less profit and it cannot really pay, no, the system that you have deployed. So actually, there's no point of doing business if you do not earn profit, no. So in accounting, although we know what is good and what is not, always take into consideration the cost versus benefit, no. So at all times when we deploy a system or internal control, at all times we should always evaluate if the benefit that we are going to get from that system is higher than our cost. Okay, so if the benefit is higher than cost, then go, well and good. But if the cost is higher than the inventory, then you should think twice in deploying that system, because that will not be good for your business. So perpetual inventory system. Let us have here an example of journal entries. Okay. So first entry here is, by the way, all amounts are assumed here. So this first entry here is a purchase of inventory on account. Okay, let's say for example on this date, no, you purchased an amount of inventory amounting to 560,000 on account. Okay, on account meaning you'll just pay later at some later time. That's why we have debited inventory and credited accounts payable. And if you sold something, no, from your inventory, no, your entry would be, for example, you sold 900,000 on account, no, to various customers. So debit accounts receivable 900,000 and credit sales revenue of 900,000. And then you will prepare a corollary entry for the recognition of your cost of goods sold, no, because since you are using a perpetual inventory system, you know that your sales has cost and you can compute that using your system. Okay, so debit cost of goods sold 540,000 and credit inventory 500,000. The effect of this entry is that you'll be able to recognize cost of goods sold in your income statement, and since you credited inventory, that actually deducts from your balance of inventory. So based on our given data, our inventory is 560,000, assuming there is no beginning inventory. So 560,000, and your cost of goods sold is at 540,000. So your inventory balance is at $20,000. Okay, in the financial statements, you should see like this. No, if those are what happened in your business for the specific period. So you can see in your income statement sales revenue of 900,000. Of course, your sales revenue should be higher than cost, no, because you have to put markup on your goods. You cannot, as I've said, you cannot do business when you will just lose. Okay, so cost of goods sold is 540,000 and your gross profit is 360,000. Also, in your balance sheet or in the statement of financial position, you need to report inventory, no? So how much is the remaining balance of inventory, and report it under your current assets. Okay, in this case, $20,000. Okay, we also have here costing methods of your inventory, and we will discuss them one by one. Specific identification method, average cost method, first in, first out method, and last in, first out method. Now, last in, first out method, as of, if I recall it right, starting 2005, it is not recommended by the standard as of 2005. No? So the Philippine Accounting Standards only recognizes specific identification, average cost, and first in, first out. Okay, but for discussion purposes, we will still discuss last in, first out. Okay, specific identification method. So some businesses deal in unique inventory items such as automobiles, no, antique furnitures, jewels, and real estate. Okay, these businesses cost their inventories at a specific cost of the particular unit. For instance, a Toyota dealer may have two vehicles in the showroom, a base model, and that cost the dealer $19,000, and a luxury sport model that cost the dealer $330,000. If the dealer sells the luxury sport model, the cost of goods sold is $30,000. The base model vehicle will be the only unit left in inventory, and so ending inventory is $19,000. Okay, so specific identification is too expensive to use, no? That's why specific identification method can only be used in items which has also high in value, no? That's why the example given here is automobiles, antique furniture, jewels, and real estate, because those items have relatively high in value. You can actually employ specific identification method because you have to monitor this cost, no? In accounting, no, as I've said a while ago, always look at the cost versus benefit. So if the benefit is you'll be able to monitor your inventory which has higher value, like this inventory, then I guess specific identification would be good for you. Okay, so specific identification method, you are assigning specific cost per item. Okay, distinct per item. Okay, so every time you sell something, you'll be able to know that the cost of that specific item and report that in your financial statements. Next is average cost method. Okay, so for average cost method, you are computing the average cost of an item, no? You deduct that by total number of items, and you'll be able to arrive at the average cost. That average cost will be used for the computation of your ending inventory and cost of goods sold. Let's have here an example. Assume that an Under Armour outlet store began the period with 10 t-shirts. Okay, so that means that is your beginning balance. That cost $10 each. The beginning inventory was therefore 100,000. So that's 10 times 10. During the period, the store bought 50 more t-shirts, sold 40 t-shirts, and ended the period with 10 t-shirts. Okay? So na ay beginning nga t-shirts nga 10. Then there is this purchases of 50 t-shirts and you sold 40 t-shirts, meaning your ending balance is 20 t-shirts. Okay, so that is the illustration. No? So we have here the goods available. So your goods available is your beginning balance plus all your purchases. So in this case, goods available is 10 beginning plus 25 plus 25 equals 60. No? It is not shown, no, but actually there are two purchases here. No, one is 25 and the other is 25. That's why there is 50 t-shirts being purchased. So goods available is at 60 units. Okay, and let us say for example in each purchase you have these figures. Okay, sa beginning inventory is at 100. Your second purchase amounting to 25 t-shirts is at 350, and your second t-shirts worth $450 is 25 t-shirts. Okay, my question is, why did the cost of the t-shirts have gone up from 350 to 450 when in fact t-shirts or number of t-shirts it's still at 25? Okay, so the answer would be probably there increase in price of the t-shirts. Probably the demand became higher. That's why the price goes up also. Okay, so when the prices are different, beginning plus purchases, of course you'll be able to arrive at your average unit cost, no, in order for you to get your cost of goods sold and inventory. Okay, in this case, our total cost of the 60 t-shirts which is available is $900. No, that's 100 beginning plus 350 plus 450 equals 900. That is your total cost. And you also have your total number of available units. Okay? So we also know that the goods which are sold is 40 units, no, and it's given. And your ending inventory is also 20 units. Okay, remember that your number of units in your cost of goods sold plus number of units in your ending inventory should be equal to the number of units in available for sale. Okay, in this case, there are 60 units available. So you sold 40, meaning there is the remaining of 20. Okay, so the average cost method, sometimes called the weighted average method, is based on the average cost of inventory during the period. Okay, using the data above, the average cost method is determined as follows. Okay, so we have here cost of goods available. So in this case, $900 divided by the number of units available. In this case, 60 units. And you'll be able to arrive at the average unit cost of $15. Okay? So our cost of goods sold now can be computed by getting the cost or number of units sold times the average cost per unit. So a number of units sold is 40. You multiply that by $15 equals $600. That is your cost of goods sold. And your ending inventory is computed by multiplying the number of units on hand or the remaining amount of inventory times the average cost per unit, which is $15. So 20 times 15 is $300. Okay, so in this case, your income statement should show cost of goods sold of $600 and your balance sheet should show in your inventory under the current assets section $300. Okay, so this is how the T account of inventory looks like. I'm sure you all know what T account is. No, yeah, T account is the shortcut of the ledger. So all the transactions on the left side represents debit and all the transactions on the right side represents credit. Okay, so total beginning balance here is at 100. No? So that's 10 units at $10 each. And we have two purchases. the first purchase is 25 units at $14. So that's $350. And another purchase, 25 units at $18. That's $450. No? Okay, these black items here are already given, no, in the problem. And you will credit cost of goods sold for the items that are sold. No? So 40 units times the average cost per unit of 15. So that makes it 600. And your ending balance of inventory is 20 units times the average cost per unit of 15 equals $300. Of course, this should be balanced, no? So all of these items on the debit side minus all of these items on the credit side equals $300. Okay, next is FIFO, or first in, first out method. Under this method, the first cost of, into inventory are the first cost assigned to the cost of goods sold. Hence, the name first in, first out. The following diagram illustrates the effect of FIFO costing. Using the same example, okay, we'll use the same example, only that we will deploy FIFO method in the determination of cost of goods sold and inventory. Okay, so this is how you're going to analyze if you're using FIFO. So you have, again, you have 10 units beginning. You have purchases of 25 units and another purchases of 25 units. So if you sell something, FIFO method, if you're using FIFO method, it is being presumed that if you sell something, the first item that is sold is your beginning balance first. If your beginning balance will be exhausted, your next item would be the first purchase. And then after the first purchase is exhausted, the next would be the second purchase. Okay, in this case, our sold items is 40 units. So we'll now identify where that 40 units came from. If we are using FIFO, of course, the 10 units should come from beginning balance. No? That's why it is forwarded here, 10 units at $10, so 100. And then, there is still remaining 30 units. So, of course, the next would be this 25 units. So, 25 units is included in the cost of goods sold. 25 units at $14. So, forward this in the cost of goods sold. And lastly, how much is the remaining amount? So, you already have sold the 10 units beginning balance. You already have sold the 25 units first purchase, amounting to 35 units. And since you only sold 40 units, the remaining 5 units is attributable to the second purchase. So the 5 units is attributable to purchase number 2. So your cost of goods sold should include 5 units at $18. Okay, so that's how you are going to analyze if you are using FIFO. So get the total of those items and you'll get $540. So your ending balance, of course, the ending balance is the latest inventory. So this will came from purchase number 2. Okay, purchase number 2. So 20 units is the remaining items times $18. So that is the latest purchase, equals 360. Okay, so there is this slight difference, if you are using average or FIFO. Later on, we will compare the difference. Lastly, last in, first out. As I've said a while ago, last in, first out is not anymore suggested by the Philippine Accounting Standards. No, we are only discussing this for the purpose of discussion, for the purpose of illustration. But it's not actually being implemented in actual practice. So the last in, first out method or Lifo method of costing is the opposite of FIFO. Under Lifo, the last cost into inventory go immediately to the cost of goods sold. So it's opposite. Now again, we'll use the same example a while ago. So if we are using Lifo or last in, first out, Okay, the portion here is still the same. Okay, the only different item here is the blue one. So cost of goods sold is 40 units. So under last in first out or LIFO, the first item to be sold is the last item that has been purchased. No? The reason why this has been disallowed by the standard is because sometimes it's impossible for you to sell a unit or an item which has been purchased lately. No? So it's not that sound. No? But anyway, no, since we are discussing LIFO, we'll continue. So out of the 40 units, since we are using LIFO, the first unit to be sold is the latest item. So in this case, the purchase number 2 is the latest item. So 25 units. So we have 25 units at $18. Okay, so that's 450. So how much is the remaining? It's only 15. So ang 15 will be applied to the first purchase. No? So then he's at tag $14. Okay, so 15 units at $14, 210. Okay, 660 ang total sa atong cost of goods sold. Then we'll have our ending balance of $240. Okay, so we'll have here the comparison between the three methods, no? FIFO, LIFO, and average. Okay, so sales revenue assumed only, and our cost of goods sold here, no? If you notice, for FIFO 540, which is computed a while ago, LIFO 660, and average or weighted average is 600. We have here the gross profit, no? Gross profit is sales minus cost of goods sold. For FIFO, we have $460. LIFO, we have $340. And average, we have $340. Okay, so $400, sorry. Okay, so this means that in this comparison, no, we will be able to see that if we are using FIFO, no, and the prices are increasing, because in our example, the prices are increasing. If the prices are increasing and we are using FIFO, we are having our gross profit at its highest and our cost of goods sold at its lowest. And if we are using LIFO, we'll have our gross profit at its lowest and cost of goods sold at its highest. Okay, so the effect would be reversed if the prices of the goods that we are selling is decreasing. No? Because in this case, the prices of the goods is increasing. So if the goods or the prices of the goods is decreasing, the effect would be different. No? The effect would be in reverse. Okay, let's continue with comparison. Okay, so when inventory, no, this is what I discussed a while ago. When inventory costs are increasing, your cost of goods sold, no, this is your cost of goods sold here and your ending inventory, and these are the effects. No, so our example is or belongs to panel A when inventory costs are increasing. Okay, so that's why if we use FIFO, our cost of goods sold is lowest, no? And our ending inventory is highest. No? If we use LIFO and the inventory costs are increasing, our cost of goods sold is highest, no? Because we are using the latest cost. And our ending inventory is lowest because we are using the early cost. No? And on panel B, if the inventory costs are decreasing, of course the effect is in reverse. No? If we are using FIFO, our cost of goods sold is at its highest, no? Because we are using the early cost, which are high. And our ending inventory is at its lowest because we are using the latest cost, which are low. Okay, if we use LIFO, or last in first out, our cost of goods sold is lowest. Okay, because we are using the latest price, and our latest price is decreasing. And if we use LIFO, our ending inventory is at its highest because we are using the early items, no, early price. That's why we have a highest ending inventory. Okay, so that would be the end of my presentation. Okay, thank you very much. Take care, stay safe, and God bless us all.